Welcome to Three Towers Investing Channel. As we all know, China has developed into a global economic superpower over the last 2 decades, and it is the only country in the world that has grown at the same rate as it has. In today's video, we'll talk about China's economic progress, and together we'll see if it's real or just a deception. So stay tuned and watch the video till the end. But before we start, hit the like button, subscribe, share, and click the notification bell so you won't miss out. So now that you've done that, let's get started. In the previous 20 years, China's economy has grown tremendously, with real estate accounting for a large portion of that increase. After 20 years of appreciation, the Chinese real estate sector is now worth over $50 trillion, 2 times more than the US and almost 4 times more than China's entire GDP. Speculators began purchasing residences solely to enhance the property's value. Year after year, China's property prices have been continuously growing for decades. However, the majority of Chinese nationals in places such as Beijing and Shanghai were unable to afford a standard house or apartment since property costs continued to grow. So the next logical move would be to buy a house close to the cities, but far enough away that the prices are fair. People began to move 10 to 15 miles away. As a result of the increasing demand for homes near cities, prices began to grow, prompting residents to relocate even further away. Property developers proceeded to build residences further and further out from the town center because they were convinced that the growth would continue. These days, there are many contemporary buildings in decent shape if you drive an hour or 2 outside of Beijing and Shanghai. However, there is one problem. Buildings, houses, and apartments are empty. This is evidence of China's expanding real estate bubble, which is a major economic engine. Take a peek at Ordo's new town, China's most famous ghost town. The city was supposed to hold 1 million people, but that amount dropped to 300,000. Then 100,000 in 2016. According to Loomis Sales, an investment management business, real estate accounts for 70% of China's total wealth. This is compounded by the fact that rising housing prices create a fear of losing out, leading people to take out dangerously high amounts of debt. 4 of the top 10 most expensive cities to buy a home are all in China. According to ARK Invest CEO Cathy Wood, China's expansion is comparable to Japan's 30-year economic catastrophe in the early 1990s. China is presently experiencing the world's largest housing bubble, similar to how Japan's GDP was powered by a real estate boom. We saw this previously in the 2008 US recession, and we're seeing similar indicators again in China. As with any financial catastrophe, greed grabbed center stage, and developers were quickly saddled with too much debt to handle. Evergrande has become one of the world's greatest real estate developers by issuing corporate bonds to overseas investors. Evergrande's real estate portfolio now includes more than 565 million square meters of the development area. Evergrande has become the world's most valuable real estate corporation. However, Evergrande was only able to do so because it borrowed almost $300 billion. As investors recognized Evergrande was in serious jeopardy, the optimistic attitude began to turn rapidly. Evergrande was recently classified as in default by credit agencies after the business failed to repay $260 million in interest payments. Even though Evergrande is a big fish in the water, it is merely one of several developers that are defaulting. Another developer, Oceanwide Holdings, went into default on a $175 million loan. In the 4th quarter of 2021, a total of 484 enterprises were late on at least 3 commercial payments, according to a recent exchange. In December 2021, contracted sales for the top 100 real estate development enterprises were down 35%. According to Cathy Wood, this is the first time in over 20 years when development businesses have seen a reduction in revenue. Japan was the standard for developing economies in the 1980s. Economists predicted that Japan will soon overtake the United States as the world's most powerful nation. According to news sources, Japan's potential land value was 4 times that of the whole United States. Other nations admired Japan's fast-growing real GDP, which increased at an annual pace of 3.89% in the 1980s. After decades of booming economic expansion, Japan experienced a massive debt crisis. By 1982, the Japanese stock market had fallen by over 60%. The Nikkei index fell another 45% during the following 2 decades on top of the previous 60% collapse. China, according to Cathy Wood, is in a similar scenario. Chinese real estate prices have reached new highs, fueled by the country's mounting debt issue. In November 2021, Chinese property sales declined by more than 16% year over year, while new home prices fell by 0.3% month after month. A 0.3% drop month over month may not seem like much, but when annualized, it amounts to a 3.6% drop. Housing prices in China have dropped to levels not seen since the country's economic recession in 2015. According to Cathy, China's GDP is expected to slow dramatically in the next 3 to 6 months. Iron prices have dropped 35%. The Baltic Freight Dry Index has dropped over 40%. DRAM prices have down 25%, and US timber prices have dropped 33%. The Chinese real estate market is in real trouble, and it's going to get worse. The rating agency S&P predicts a 10% reduction in residential sales across the country as a result of credit tightening and restrictive laws. Many analysts consider China's high GDP growth to be a sign of economic success. However, a vast debt bubble, not only in real estate but across China's economy, has fueled much of that expansion. According to the Fed, it's true that China's GDP has been rapidly increasing, but China's debt balance has been increasing much faster. The Fed also mentioned inflated real estate prices and how the Chinese Communist Party's crackdowns may bring such valuations crashing down. That comment was made in response to the Chinese government's 3 red lines policy in the real estate sector. A liabilities to asset ratio of less than 70% is one of the 3 conditions, cash to short-term debt ratio of 1, and a net debt equity ratio of less than 100%. Cathy Wood compares the CCP's action to playing with fire since their new regulations have the potential to burn down the whole property sector. At least 1 red line has been violated by 2/3 of the top 30 Chinese developers. The only option to stay inside the boundaries is to sell houses, which is exactly what many developers are doing now. Evergrande is attempting to sell the Evergrande Tower in Hong Kong, which houses the company's headquarters. Kesa Group Holdings has put 18 of its projects on the market with a total square footage of 4.7 million square feet. Kesa, like Evergrande, has yet to sell any of these projects. The issue with all these properties going on sale is that there aren't any buyers available. This is because all of the other real estate developers are also trying to meet the 3 red line requirements. If there are no buyers for all these properties on the market, the only solution would be for Evergrande and Kesa to lower their prices. And if those prices are continually dropped, the market will eventually collapse. Property development accounts for 29% of China's overall production. According to the Federal Reserve, China's impending downturn will affect individuals all across the world, not only Chinese nationals. According to the Fed, China's economic downturn might put pressure on global financial markets, putting global economic growth at risk and affecting the United States. In other words, if the Chinese real estate market collapsed, the world economy would suffer. Why don't you share your thoughts in the comments section below? Your opinion matters. If you like this video, don't forget to hit the like button, share, subscribe, and click the notification bell. This is your 3 Towers Investing channel. giving you the latest in finance, investment, and innovation. Thank you for watching, and I'll see you in the next one.